welcome. You're watching Indian Open right here on Bloomberg Quint Live. Good morning, Neeraj. Last week was a bumper week for Indian equities, 3.8% on the indices. Broader markets faring even better.
Yeah, and that's the call, right? Because of the relative underperformance of the broader markets, can they now make a comeback and will people be comfortable placing bets at the broader end of the spectrum?
The other part of it is obviously at a time where the India VIX ahead of the election numbers, spiked up all the way to about 28, half 29, around those levels, which showed uncertainty and the overhang of the election outcome. That fell off substantially, now at about 16.52. That has actually fallen in line with the CBOE VIX, which is the global gauge of volatility. So that probably indicates now that it's going to be the global shocks and what happens to the global equity markets that will drive the sentiment around Indian stocks going forward. So while your own internals in terms of the political overhang seems to have come to an end, whether or not the next leg up or the next big volatile moves come in on the back of what the CBOE VIX does as well.
Yeah, should be interesting to see what happens there. So volatility's come off. Let's see. Now it's back to basics, and basics suggest that there will be a lot of companies that will react based on the numbers that have come out. Jockeys, Indian license holder, has had a tough ride in the fourth quarter. Page Industries saw the top line remain flat in the Jan to March quarter, the first time in a really long time. Samit's back with us to take us through the numbers in what is arguably the result of the day. Samit, why are the numbers so bad?
Well, I'll give you first the headline numbers, and in fact that headline numbers will only tell you why the numbers are so bad. Now, if you see the revenues of the company, they remained flat compared to last year to close to 608 crore rupees. Now, this is for the first time in at least the last 5 years where the revenue growth of the company has remained flat. Now, if you see the EBITDA of the company, that was down nearly 19% to close to 120 crore rupees. Now, this is the first fall in the company's EBITDA in at least the last 5 years. Margins contracted to 19.7%, while the net profit of the company was down by nearly 20% to close to 75 crore rupees. So what impacted the fourth quarter financials of the company? Well, it was the weak realizations, lower volume growth and higher cost. Now, realizations were weak for the company because they had introduced some schemes and discount to boost the sales for the company. However, that did not take place because if you see the volume growth, that was only 1% due to slowdown in the market that we have seen and because of the liquidity issues that has been going on. Now, if you see on the cost side, the company's employee cost and other expenses as a percentage of sales, but that increased. Now, employee cost as a percentage of sales stood at close to 20.5% versus 16.2% last year, which was the highest in at least the last 5 years. Other expenses as a percentage of sales, now that stood at close to 23.4% versus 22.3%, which was the highest in at least the last 2 years. Now, because of these two costs, the total the company's EBITDA declined by nearly 18%, because of which the margins also contracted. However, a couple of positives that we had seen in the fourth quarter. Firstly, the gross margins, now that expanded to 63.6% due to stable yarn cost, and the company also declared a dividend of close to 41 rupees per share in the fourth quarter. That was the final dividend that was announced by the company. Now, what the management said in the conference call, if you see, the management said that post GST, the inventory held by retailers has been lower than the past, but recent liquidity issues were more severe and has impacted trade in the fourth quarter of financial year 2019. It also said that there has been no signs of an uptick in demand in the last 2 months, but they're expecting situations to improve, and that is the reason that inventory has sharply increased as they're preparing for a stronger demand. That's what the management said in the conference call. Now, guidance wise, if you see, the management is targeting a 10% volume growth and a 20% sales growth for FY20. Now, the sales growth would be higher because of price increase, better mix and greater share of higher priced products which are likely to boost its realizations and its overall sales. Lastly, if you see, for FY20, they have maintained their EBITDA margin guidance at 21 to 22%. Now for FY19, the company did a EBITDA margin of close to 21.6%, but overall for Q4, if you see, the margins were lower at 19.7%. So if you see, overall the company guidance for EBITDA margins is on a positive side of 21 to 22%, but the commentary that the management has given regarding the sales is quite negative. So let's see how the stock reacts today on that.
All right, so Amit, thanks very much for that. So Page Industries, a howler of a quarter for the company. Let's see what it does as it opens up for trade this morning. 21,944 is where it shut shop in Friday session. Avinash Gorakshakar, Head of Research at Joindre Capital Services, joining us on the show right now. Avinash, have to start off with Page and what kind of numbers it posted.
No, I think clearly quite disappointing numbers, from both the top line as well as the bottom line miss. I think what is important is what is the kind of management commentary as far as the margins are concerned. I think clearly the markets would be looking at EBITDA margins, because if there is some pressure on these margins going forward also, that could impact their ROEs and obviously absolute profitability. This is one company, Devina, where the ROE has constantly been above 35 to 38%, and I think once EBITDA margins come under pressure and there's an absolute fall in profit, definitely this is a big negative surprise, and probably today you could see the stock under significant pressure. Hopefully, I think the entire space, within the housery segment could possibly see a kind of a minor sell-off today, because Page represents the Indian industry as a whole. So I would believe that it's better to wait and watch rather than jumping the gun. But yes, numbers are definitely much against what the street expected, and that too on a high base. Now growth going forward would be a little difficult.
Avinash, the other thing is the rules that have come out for the NBFC space.
Yeah.
Now, we just spoke to an analyst who believed that there won't be too much of a reaction on some of the NBFC names. Would you differ? Would you believe that these norms will make it difficult for any of the smaller NBFCs, and therefore, would you get out of any of the NBFCs, or would you recommend getting out of some of the NBFCs?
No, I think Neeraj, within the NBFCs, I think those NBFCs which have a fairly stable ALM and which have got a large liquidity kind of cushion are definitely going to do well. I think the smaller ones are definitely feeling the heat, and probably within the housing finance space, that could be one area where the maximum pressure could be seen. I would believe that within the housing finance space, companies which are largely dependent on the loan against property kind of market would be ones which would suffer the most. I think clearly bigger ones like maybe typically a Bajaj Finance could actually gain and capitalize, from this kind of consolidation happening in the market. As far as the norms are concerned, I think, we would like to wait for the finer details to come out, and most importantly, it would take some more time to evaluate whether, these norms would actually help the larger NBFCs and make life more difficult for the smaller ones.
Okay, but obviously implementation starts April 2020, so
Yeah.
you still have a one-year period over which maybe things could actually start to turn around. But let's actually talk about individual counters, more numbers coming out today from the index as well. We've got our full team here with us, all our researchers to talk about GAIL. We've got Z Entertainment numbers. Remember, this is going to be an important one to watch. And then which were the strong numbers that came out over the weekend versus the weaker ones. So let's start off with you first, Mishika. Z, the big number today.
Yes, so we're expecting good results from Z this quarter. All the key numbers are expected to rise significantly. The revenues are expected to increase 13% at rupees 1949 crores versus 1725 crores. The net profits should go up by 46% at 337 crores. EBITDA is expected to be higher by 14% at 578 crores, and margins should increase slightly at 29.6% versus 29.3%. Now the revenues are going to be aided by a surge in ad revenue and domestic subscription revenue. Ad revenue growth should transpire on account of the festive season and resumption in ad spends. International revenue should be buoyant, led by currency tailwinds, and domestic subscription revenues estimated to remain robust on account of phase 3 monetization and digitization. Z5 will also continue to contribute to ad and subscription revenues, and EBITDA margins should expand on account of healthy revenue growth.
All right, Mishka, thanks very much for that. Important to see what Z does. Remember, Dish TV saw a big slump in profits. Obviously, there was a one-time hit that they took. But aside from that, from the oil and gas space, Amit, GAIL comes out with numbers today.
Well, the numbers are expected to be weak compared to last quarter. Now, the revenues of the company are expected to be down by nearly 6%. Net profit is expected to be lower by nearly 14%. EBITDA is expected to fall by nearly 12%, while margins are expected to contract to 12.6%. On the operational side, if you see the gas transmission volumes, they are expected to be down by nearly 0.4% to close to 107.6 MMSCMD, while the petrochemical volumes are expected to be higher by nearly 13% to close to 195,700 metric tons. Now, it is expected to be a weak quarter because of lower LPG prices, weak LNG imports, and low spot LNG prices that we had seen in Asia. However, the petrochemical business and the LPG transmission business should be better compared to last quarter. Now, because of the decline in oil prices, the LPG prices also declined with a lag effect, because of which the LPG segment could be weak for the company. Along with that, if you see the LNG imports, now they were also weak in the fourth quarter, because of which the gas transmission volumes are expected to decline by 0.4%. On the marketing segment, if you see the oil price, the gas gas prices in Asia were weak compared to the US gas prices, because of which there could be some losses that we can see on the marketing segment, and because of this low LNG prices, the company could also report an inventory loss in the fourth quarter of financial year 2019. Now, however, if you see in the third quarter, the petrochemical business, the petrochemical plant was shut down, because of which the fourth quarter is expected to be better sequentially for GAIL, that is the petchem segment, and the LPG transmission business. Now, there also EBIT would see a bump up because of the price hikes that had been effective from the November 1st, but the amount for this will be coming in the fourth quarter. So in the fourth quarter, the company will receive the full amount of the price hikes that had seen in the last 5 months of financial year 2019. Lastly, key things to watch out for from GAIL India earnings would include the updates on the HVJ pipeline tariffs, along with that the status of the Kochi-Mangalore pipeline project, along with that management commentary on placement of US contracts, and any guidance on transmission volumes would be important to watch out for from GAIL India earnings today.
All right. Thanks a lot for that, Samir. Some strong numbers over the weekend. Yash?
That's right, Devina. So, like most of the cement pack, India Cements too came out with an extremely good set of numbers. Their revenues on a year-on-year basis are higher by about 11.5%, coming in at about 1,560 crore rupees. Net income is up 24% at 44 crore rupees, aided by another income element of almost 17.5 crores in this quarter. But that apart, the operational performance too was very good, as the EBITDA is up 39% to 210 crore rupees. That apart, Balrampur Chini came out with extremely good set of numbers. The sugar names have been performing very well over the last 2 quarters. Balrampur Chini saw its revenues grow by 29.5% to 1,327 crores. Net profit of 285 crore rupees versus a net loss in the same quarter last year of 42.5 crore rupees. Now, despite of there being an exceptional gain in the form of a deferred tax income of 106 or 107 crore rupees, adjusted for that too, the company remains in the black. So that is something which is a key positive for Balrampur Chini. And that apart, we are also tracking NCC, which came out with an extremely good set of numbers. Their revenues are up 44% on a year-on-year basis, coming in at about 3,761 crore rupees. Net profit is up 4 times at 188 crores. EBITDA is up 58%, and margins, they have come in at about 12.6% versus 11.4%. So all in all, extremely good set of numbers for NCC.
All right, so we'll watch it to see if the positive open works for these companies. But let's talk about some weak numbers. Nikki.
4 numbers that I'll be addressing. First one is Bata India, where the company has reported weaker than estimates number. On the face of it, looks like a decent set of numbers. Top line, it's a 7% growth. EBITDA is 14.8% higher at a number of around 94.5 crore. But this compares to the estimates of around 114 crore. Mainly higher rental and the other expenses have weighed on the operational performance of the company. This JV, that's again a weak set of numbers. Top line, we've seen a 9% downtick there, year-on-year basis, consolidated. Subscription revenue and bandwidth downtick that we've seen mainly has impacted the top line, effect of which you've also seen a downtick coming in on the operational numbers. The company has reported a net loss of around 1,300 crore, more than 1,300 crore, and net profitability in the previous quarter stood at around 121 crore. That's mainly on account of exceptional loss also to the extent of around 1,500 crore in this current quarter. However, other expenses have been lower for the company. If you look at Avanti Feeds, again, a weaker set of numbers reported by the company. We're seeing a flattish growth there on the top line. Profitability too has taken hit, mainly on account of the EBITDA performance, which has seen a downtick of 20.4%. Also factors in inventory gain of around 35 crore in the corresponding quarter. And last in the list, we have NTPC, where the numbers were below estimates. Revenue, we saw an 8% downtick there. Net profitability too was lower by more than 45%, and profitability saw operational level to a hit. Margin shrunk to 21% as compared to 26%, and the profitability was higher mainly on account of 2 parameters, that is the deferred tax reversal that we saw in the quarter, and also the other income, which rose by more than 3 times or 2.5 times in this quarter.
All right, guys, thanks a lot for that. So we're going to watch out closely for all of these stocks as they open up for trade. But the key one that I want to talk about today, Avinash, is Z. Now, obviously, this stock has been in focus. A lot of volatility within the stock prices and big, heavy moves coming in. Now that we know, operationally, there's never been a question on what disease performance can be. But do you think that's something that probably is a reason why you should go and enter the stock?
I think, Devina, as far as the numbers are concerned, there's no doubt that the bottom line growth in this quarter is going to be pretty solid. I think the street is estimating a 27 to 28% growth in the consolidated PAT. Both the OTT model as well as the broadcasting model should record decent EBITDA margins. I think the stock has seen a fair bit of overhang largely because of the pledging issue, and I think unless the markets get a hint on the pledging issue, what has been the update, I would believe that the markets would be keenly watching this development very closely. The management has given a September deadline, and hopefully if it happens before that, then only one could see a significant re-rating on the stock. But otherwise, purely on numbers, I wouldn't be surprised that the stock could see a significant amount of uptick today. I think broadly, the pledging issue is going to be a more important issue than the broad numbers.
Avinash, two strong numbers that came out. Which one did you like more? Nagarjuna Construction Company or India Cements?
I think Nagarjuna stands out because clearly not only in terms of the profit, Neeraj, but in case the EPC kind of business, I think despite being a working capital dilutive business, the order book has grown, EBITDA margins have also grown, and I think the management commentary is also pretty decent. I think India Cements also looks good, but I think clearly from a longer term perspective, I think within the EPC and the construction equipment, construction market point of view, I think NCC should definitely see a strong uptick not only today, but going forward, hopefully if it does maintain the order track and these kind of margins, it should be a better bet.
It'll be interesting to see what so one is Nagarjuna Construction Company, and the fact that their numbers have looked so good. They haven't provided the guidance for FY20, mind you. So when the management speaks to us later on in the day, it'll be interesting to know from them what the guidance is for FY20. So that is one. And as far as India Cements go, Devina, one, it had a big move in Friday's session. So it's had a bit of a rally already, 12% up in Friday's trade, and which kind of brings the 1 month move into positive. So this is the move in Friday's session. But look at the numbers. Capacity utilization levels went up to 84%. That's quite stunning. Typically at these levels, the companies have some pricing power as well, and they'll be thinking of expansion. But irrespective of the expansion, that the companies have some pricing power. The EBITDA per ton went up to 629 rupees in Q4 from 470 in Q3. And with the new government in Andhra Pradesh giving push to infra and housing, there is very little reason to doubt the positivity that could come in India Cements as well. So we've seen a bunch of mid-sized cement companies come out with good numbers. This one is no different. However, let's take it to the big conversation on Bloomberg Quint. Remember, the result season is done now, and what will be important is to figure out what is it that brokerages or large brokerages are doing. The first of the block with a very large conference is Axis Capital, and their conference is starting today. The Joint Managing Director and Co-CEO Chirag Negandhi and Managing Director for Institutional Equities Mr. S. Subramaniam join right now on the show to talk about what is at hand in the conference, what are the kind of participants, and what is the central message that they are giving in. Gentlemen, both of you, thank you so much for joining in. Good morning. Mr. Subramaniam, I can start off with you. It's coincidentally or otherwise, it's an apt time to have a conference. The result verdict is strong. FIs are bullish if the flows are to be seen the last 1 week. What's the central theme at the conference today?
The central theme at the conference is that with the government getting a reasonable majority, you would see all the uncertainties about the past getting behind us. The global scenario, except for the trade war, in terms of the rates being down, is also there. The rupee is going to be strong. So we think it's a generally positive across the board. It could be a little bit, some parts of the economy will move ahead a little faster and earlier than the others, but we think that overall the entire market is going to see a uptick. That's what we believe. We believe that the construction and the job and the investment push is going to start earlier. The consumption push will happen as a follow-up a few quarters down the line.
Okay. Chirag, what's the nature of the participants that are coming in today? Would it be a large community from the foreign institutional side as well? Because they have been the ones that are looking largely positive.
That's true. So we actually have about 120 corporates and about 450 fund representatives. These are a mix of both domestic as well as foreign investors. A lot of foreign investors as well. The interest level is palpable simply because the election, and the result uncertainty is now behind us. And everyone's coming in wanting to meet companies. We're doing over 3,500 meetings. The idea being people want to understand where the earnings momentum is coming in, how the recovery is happening for each of these companies, what themes really will play out, and therefore where they can actually look to invest more and more of the money. I think the funds are clearly there, and the flows are clearly there. And the broader markets are expected to do well, but it's stock specific that people are still trying to go and see the themes and the stocks that they can actually look at now.
So Chirag, what is the central theme around the conference this time around? I mean, we've seen consumption suddenly take center stage with the kind of conversations around the slowdown. We've seen infrastructure, now that the election verdict has come out. Infrastructure is going to be a major talking point for the near future, and what the government does thereof, and therefore what happens to companies' earnings. So what is it that you think is the central theme this time around?
So to our mind, the work for the government is cut out. They had to move the people from the fields onto, and the farms onto the factory floors and to the project sites, and that's really where the theme is built around. We want this to be more of an infrastructure and investment-led theme. We believe that the consumption will pick up over the next 2 quarters or so, but the first part of the push will now come from investment-led. Private sector investment has to be upped. The cement demand, we are seeing cement numbers, company after company are delivering good numbers, and therefore that's the theme that will play out. Banking being 40% of the indices is always a major theme. So to us, it's more banking, cement, auto, and investment led, and the consumption part can then come in 2 quarters out.
Mr. Subramaniam, what's the feel that you're getting from participants? It's too early, I know. They haven't probably started, but you would have had a sense of what participants are saying. Are large funds bullish on India? Are they willing to put in fresh money to work at the current valuations? And part 2 is, what is the advice that you as a house are giving to those clients? Are you telling them to put in fresh money to work at these valuations?
We are saying 2 things. One is that we are saying that it's worth putting fresh money into the markets to work now. We told them, come across to the conference, meet individual companies so that you can make a learned choice as to which stocks you want to put money in. But as a house, we are pushing people to come in. We believe that if the government does what Chirag has been talking about, move people from farms to factories and to project sites, we would see a significant positive momentum in the markets. What have the funds been saying? The funds are now saying that one big uncertainty is behind us. The funds are watching out for 2 things. One is that is the NBFC issue going to be sorted out as quickly, so that now you can focus on individual companies and see which one's going to be the big winner. That's the one thing. The second thing which they are looking for and they're hoping is that there is going to be another round of an interest rate reduction. Both of this we believe will happen, and as that happens we will see continued foreign and domestic money coming into the markets.
All right, so Mr. Subramaniam, while we've discussed the central theme of the conference and what comes about, what is it that Axis Capital is looking forward to in terms of their commentary to their clients over the period of 1 year?
I think we just released 2 notes over the last weekend and today. In terms of the major themes which we are focusing on, is that the initial part is going to be an investment-led pickup, which means that the stocks which are going to come up are going to be beneficiaries of that theme, which is engineering, cement, and of course the large lenders. Those are going to be the very, very big one. Auto is going to be a big beneficiary as well because it's a bombed out sector. So we're going to see a significant pickup there. On the consumption side, we think that as the jobs get created, as the economy goes up, the consumption theme will be a beneficiary, but they would be a beneficiary a couple of quarters down the line. And therefore, we are telling people to go first into the investment-led theme and then follow up with the consumption-led theme a couple of quarters down the line. That's exactly what we've been pushing our investors to do.
All right, great to hear from you, Mr. Subramaniam and Chirag. Appreciate you both taking out the time and joining us. We're just running a little tight on time. We've got the market pre-open in just a few minutes, so we'll have to leave this conversation here. But really appreciate you taking out the time and joining us. Thank you so much.
Thank you.
Thank you very much.
All right, back to the markets then, and our technical experts are joining in as well. We've got Brijesh, Bhatia and Amit Shah, both of them here to take us through their individual strategies on the index as well as individual stocks. Brijesh, let's start off with you first. Your call on the Nifty or the Bank Nifty?
So if you look at the last session, may have seen a good up move coming back after selling pressure in the second half of the event day, and I think we are again poised for a 12,000 levels rally, and one can look for the risk reward wise, one can look for going long on 11,900 call because in the future the stop loss is slightly bigger of around 180, 190 points. So I would love to look go long around 11,900 call, which is currently ended at around 70 with the opening showing it might open at around 55 to 59, and one can look for an buy opportunity with the stop loss of around 22 to 24, and I'm expecting the target of around 115 and 20 on the upside, which would be equivalent to around 11,950, 980 levels on the upside. On the stock side, I think one can look for a long opportunity where the momentum is very strong. The first is LIC. LIC has given a strong momentum and trading at nearly 8 months highest level. So at around 538, one can look for a target of around 580 with the stop loss of 525.50, slightly below the momentum low of around 526. The second stock is DCB Bank. We have seen this stock been trading consistently on the bullish side, despite the markets saw a swing on the downside. But this stock has managed to hold around 210, 215 levels, and we have seen again upsurge about 230, which was the previous resistance zone. So at around 233, one can look for a long opportunity for the target of 248 with the stop loss of around 226 on the downside.
All right, those are some stock ideas as well as a call on the index from Brijesh. Amit, let's get in your ideas as well.
Hi, good morning. So as we move closer towards the expiry of the May series and almost the event has already is out of the market now with VIX cooling off again back to 16 odd levels. Considering weekly close on Nifty, it was a very strong close at 11,000, above 11,800 odd mark. Now this is a very critical resistance. If I join the trend line from 2010 to 2015 odd, it is almost at those trend line levels. So it is on a rising trend line where it is witnessing some resistance around 11,800 mark. So on an expiry basis, I would be very much positive on the market. If it closes above this level, that's where we will see some kind of a fresh buying momentum. Even on the open interest side, the expiry started with 2 crore open interest base, and now the open interest is around 2 crore 30 lakh shares odd. So any rollover expiry above 2 crore will still give some comfort, with FIs also buying on the positive side. The option concentration has moved higher from 12,000 to 12,500 strike. So all these are added to the positive signs, and close above 11,800 would be treated more on the positive side of the market. On the downside now, 11,750 will act as a momentum support, followed by 11,600 from where the gap had started the momentum. So that's where the gap support is seen. So till the time we are holding above these levels, my biasness will remain positive. Though the risk to reward ratio is slightly unfavorable, but still any range of close to 11,850 on Nifty will be a good entry point to play ahead of the expiry. On the upside, I expect target towards close to 12,000 odd mark, and on the downside, I'll trade as 11,750 as a stop loss level.
All right, we've just got a minute left to go for market pre-open. We'll come back to taking Amit's calls on his stocks after pre-open, but it's going to be an interesting watch as to what happens. Remember, you have a few important numbers from the Nifty 50 coming out with results today. Z being one, you've got results from Adani coming out, from GAIL, to see all of that and how it reacts post during market open. Aside from that, the ones that reported numbers that were very disappointing, Page Industries for one, Bata disappointed again. So this is the consumption story gone wrong yet again in terms of the earnings from within this space. So watch out for how all of these stocks open up for trade. The ones that did well, India Cements, that's one stock within the cement pack, which has been doing well on Friday session, 12% higher. Whether it can do an encore of that on the back of the actual results is something that we'll have to wait and watch as well. But 12 seconds to go, and SGX Nifty is pointing towards a slower start though, about 1/3% under. That's the rest of Asia for you, 1/3% higher for the Nikkei. But China and Hong Kong looking weaker. Pre-open up on your screen. Nifty 50 opens with marginal gains, and so does the Sensex, open about 300 odd points higher, but very volatile, so wouldn't go by these index moves, at least in the first few minutes of trade. Individual stocks and the move thereabouts. Let's start off with the bigger losers then in today's session. JSW Steel down about 2 odd percent. Indian Oil is down 2.5%. Bhatia, Airtel, Cipla and ICICI Bank look weak, but more gainers than losers in pre-open. Z ahead of numbers is 1.9% higher. Grasim is up about 3.5%. The banks are doing well. HDFC Bank, Yes Bank 1% higher. GAIL is also doing well ahead of numbers. ITC, Bajaj Finance, 34.95 for that stock. Hero MotoCorp and IndusInd Bank are some of the gainers, about 0.5% higher. For the currency, some more strength. 69.52 was the close on Friday's session, so it looks like we are treading the right path for the currency, at least about 69.39 now. And for the bond market yield, 7.22 was the close. We're still about 7.22.
Well, 1% beverages, and let's see what that stock is doing. I'm not surprised really. I can safely lay a bet that it will be on a lower circuit and it will probably stay this way. With what's come out from the GST press release, this shouldn't come as a surprise. We'll talk about this in just moments from now, but do watch out for 1% beverages. Some strong results: Nagarjuna Construction Company, Balrampur Chini and Narayan Rudalaya, and we'll talk about those as well in just moments from now. But looks like these stocks will start off on a positive note. At least NCC is showing signs of that, and Narayan Rudalaya too, looking very strong. India Cements is the other one. Yes, Devina's right. India Cements. Let's pull that one up and see how that is reacting. Marginally higher after 12% of move as well. Some weak numbers too, and we'll talk about all of those stocks in a bit. But before that, let's get in Samir Sarkar, who joins him in the top brokerage calls of the day. Samir.
Good morning, Neeraj. On the big brokerage calls for the day, first we have a CLSA on Dish TV, where the brokerage has maintained its buy rating on the stock but has cut down the target price to 60 rupees from 70. Now, for the fourth quarter result, the brokerage says that they were below estimates because they were impacted by TRA's new tariff regime. Now, this implementation not only impacted the ARPUs of the company but also the subscriber additions in the fourth quarter of financial year 2019. However, over the long-term period, the brokerage is expecting this new regime to benefit this company. Now, for FY20, the management expects the margins to expand by 180 basis points to close to 35%, but CLSA says that this is mainly because of the merger synergies that the company is expecting to realize in FY20. Lastly, the brokerage says that the SL Group deleveraging will be the key trigger point for the stock going forward. The second we have is on JSW Steel, where Investec has maintained its hold rating on the stock but has cut down the target price to 289 from 300 rupees. Now, according to the brokerage, in the fourth quarter, the core operations of the company did surprise and they did offset the loss-making subsidiaries in the fourth quarter. However, going forward for JSW Steel, balance sheet improvement would remain the key for the stock, and it would be interesting to see how the company manages to acquire Bhushan Power while adhering to its lower target leverage ratios, says the brokerage. Lastly, the brokerage has cut the target price on JSW Steel to factor in the contracting spreads and the lower volume guidance given by the company, says the brokerage.
Okay, Samir, thanks very much for that. Amit, we missed your stock calls ahead of pre-open. Could you highlight what you're recommending this morning?
So I have two buy ideas. One is a buy on Axis Bank. The overall, we are seeing a good strength in the overall Bank Nifty, and I believe in the coming time, Axis Bank and ICICI Bank overall can see some outperformance overall in the private banking space. Axis Bank has reversed quite sharply from 730 odd mark and has been hovering around its all-time high, which is close to around 800 odd. So I believe it's a good momentum where it's poised for making a higher top, higher bottom formation. On the downside, it has a very good support around 775 that will act as a momentum support. And on the upside, I expect target close to around 830 to 840 levels in near term. I have a second buy recommendation on Pidilite. Now the stock has a very good weekly closing. Reversing sharply from 1000 odd levels and now almost at 1140 odd mark. A good level or entry point would be around 1240 to 1230 odd, subject to how it opens today. On the downside, it has a very good weekly closing support around 1210 odd, and on the upside, I expect target close to around 1180 to 1200 levels in near term.
Okay, we will watch out for those names as well. Back to stocks in focus, don't want to ask about 1%. I mean, anybody will tell you that the route for 1% is down. So frankly, don't bother about that. That stock is locked lower. And if you read the story on BloombergQuint.com, you will believe that that is going to be the case as well. So it's actually no prizes for guessing that this is going to be the case. Avinash, a few other stocks on which the results seemed strong or conversely seemed weak. Firstly, the stronger names. Two names, I don't know you track them or no, Balrampur Chini and Narayan Rudalaya. Did you look at the numbers of either of these two names?
I think Balrampur Chini, I think numbers have been extremely solid, and I think today the management con call would be done. I would believe the ethanol story is going to be the bigger story here, largely because ethanol makes more money than the core sugar business, and I think clearly in terms of their capacity, in terms of their volume throughput, and the kind of new tenders which are expected for ethanol in the current financial year, I think Neeraj, this could be the near trigger point. I think they have also announced a buyback, so I would believe that this stock could possibly see a further re-rating. Hopefully, what kind of management commentary comes out and what kind of ethanol volumes numbers come out in the coming year would be the key triggers. But I think clearly in terms of the sugar story, ethanol is now going to be a more important ingredient in the earnings trajectory.
You also got to keep in mind, but Dhampur Sugar, after the numbers came out last week, Friday had a big up move. It didn't quite react on the day itself of the results, but Friday had a big move, 7-8%. Balrampur Chini in the last 5 days has had about a 5% up move, and then it's come out with strong numbers. So you got to keep that at the back of your mind when you're looking to trade Balrampur Chini today, if you're looking to trade Balrampur Chini today. The other one, Avinash, and just before I actually get to Avinash, just want to mark Page Industries, because both me and Devina were talking about it. Actually, Avinash gave his view as well. Page Industries likely to be under pressure. Starts off 5% lower, 20,800. So this one certainly under pressure today. The management is guided for about 20% growth for FY20, so the guidance is okay, but clearly the steep valuations take a bit of a toll.
Yeah, but the question is, how do you look at it? If you have to look at it through an eyeglass, what do you give prominence to? The fact that it's come off from those high valuations and now looks relatively cheap to start investing in. The commentary is still fine. Management is suggesting a 20% commentary, but it's always the tussle between what do you do now, because it's come off so much from its peak valuations.
Yeah, but somehow I think, Devina, that this whole argument of a stock having come from an X level to Y level now is all bunkum, because it really didn't matter what the stock did at that point of time, because the situation has changed so dramatically. So just look at the current valuations and gauge whether at the current growth rate that the management is projecting, is it a good buy or no, as opposed to looking at 36,000 and thinking that now you're getting it cheap. Yes, it's corrected a bit.
So maybe it was a bubble then, not a bubble now.
Maybe it was fair for the valuations then, or stretch valuations. You are right. I mean, everybody spoke about it being in bubble territory then. But at the current valuations and the growth numbers that it projects, whether Page Industries is a stock to buy or no, I think anybody's guess. Avinash has given his verdict that the stock is likely to remain under pressure. And at the end of the first 8 minutes, Page Industries is certainly looking like a stock that will remain under pressure. 2,000 rupees gone, 9.5%. This is below 20,000 for the first time in some multiple years. So do be very careful about Page Industries. But Avinash, the other one, and good call Avinash, by the way, and not that matters because the stock is down 9% already. The other one is Ashok Leyland. What did you make of those numbers?
No, I think Ashok Leyland, I think disappointed the street. I think despite the fact that volume numbers have been quite strong, overall bottom line growth has not been great. In fact, the street was expecting that this quarter we could see a double-digit growth in the profitability. I think clearly, Neeraj, going forward, liquidity pressures within the NBFC space and the kind of macro headwinds, I would believe that we could see maybe in the next 1 or 2 quarters a bit challenging. The coming budget is going to be a key trigger point where the government could possibly announce some incentives for the automotive sector and possibly shore up even the infrastructure sector. So I think overall the stock could remain under a little bit of pressure, but I think near term I would not be surprised that there are no near term kind of big earnings triggers which could re-rate the stock. But yes, around 80-85 the stock could possibly stay range bound, and thereafter could possibly be a good re-rating kind of candidate.
Okay, that's Ashok Leyland for you, down about 2.5%. What happens to real estate now? Brijesh, are you tracking any of the bigger real estate names in terms of a trading opportunity?
I think Devina, last week also we have discussed Godrej Properties being the one of the strongest outperformer, and if we look at the momentum, it has been very strong, quite strongly held after a fall. It has held around 750, 760 levels, back to around 840, 850 levels. I think still it's a good buy, and I'm expecting around 950 levels on the upside in coming weeks. So any dip towards 830, 835 in case you get around 840 as well. One can go long, keeping a stop loss below 800 and back to around 950, 970 levels on the upside.
Okay, that's Godrej Properties at 881, marginally high on pre-open trade. But we're just minutes away from market opening, and we'll tell you all that you need to know to stay ahead in trade today. The Reserve Bank of India is taking action to avoid another crisis like the one triggered by IndianFS. So the regulator has proposed rules to tighten the liquidity framework for non-banking financial companies.
3 nifty companies will report numbers today. Adani Ports, GAIL and Zee Entertainment will be declaring the results.
Central GST and customs officers carried out a search and seizure at Manpasan Beverages premises. The authorities then arrested Managing Director and CFO for trying to evade GST amounting to 40 crore rupees.
Page Industries' revenue and EBITDA have declined for the first time in at least 5 years. The management says it has seen no sign of an uptick in demand over the last 2 months, but expects the situation to improve.
India Cements, Future Retail, Berhampur Chini, Dixon Tech, Narayana Hridayalaya, Amber Enterprises and NCC have reported strong set of earnings for the March quarter.
And most of them react positively as well. Amber up about 8%. And lastly, FDC's board approves a buyback of 34 lakh shares at 350 rupees per share, which is at a premium of 76% to the current market price. And that's quite steep. Avinash, do you look at FDC? Did you look at this development?
No, I think clearly, FDC announcing the buyback is quite normal considering the fact that, they have a lot of cash on the books, Neeraj, and very little expansion on the books. I would believe that, they have a limited space within the domestic market, and clearly within the, overseas markets also, they have been developing some new products. So clearly, this is definitely a good opportunity for some sort of arbitrage people who want to play on the buyback. Despite being an illiquid counter, the financials of the company are pretty solid. And I think somebody who wants to take a arbitrage view as well as a long-term view could definitely look at it if one had one has a long-term view on the stock.
Okay. Me and Avinash spoke about our analysis on Page Industries. Avinash, you already predicted it will remain under pressure. Would you go out and buy it at these levels?
I think, Neeraj, clearly, these high PE stocks, once they disappoint, I think the disappointment would continue for some more time. I think, classic examples have been DMart, now Page Industries. I think markets are definitely going to be a little wary about these expensive stocks, considering the fact that any further small negative surprise, if it does happen, even in the coming quarter, that would definitely open the floodgates for a further fall. And I would believe that, at these valuations, it would be wise enough to be a little cautious rather than putting your money at the current odd levels.
Okay. So be careful if you're investing in any of these names. Wondering from a trade perspective, Amit, would you go out and look at Page Industries, the derivatives or the charts, and try and tell us what are the levels that you see?
So if you look at Page Industries of last 2 years, it has almost taken 61% of its upside. So it has violated the key support of 22,000 and has been sustaining quite below that on a weekly basis. So I believe the more it sustains below 22,000 and violating 20,000 odd mark, there is still room towards 18,500 odd level where it can see some kind of a monthly support. So I would wait and watch till the time 22,000, 22,600 is not crossed on a sustained basis. It's an avoid on the buying side.
Brijesh, Eicher Motors, do you trade this one now?
Eicher Motor, yeah, I would look for a short opportunity because the stock has clearly given a breakdown of its 200 weekly average. It has been unable to sustain those levels. We have tried multiple times. I think still a good downside left in the Eicher Motor. So one can look for a short around 21,200. 400 levels, and I think back to around 19,400 is the level we are eyeing on the Eicher Motors.
Okay, we've got just about a minute left to go for our market opening, so I want to run through some top calls from both our technical experts. Amit, why don't you start off with one top call for the day?
So I'll be closely monitoring Axis Bank as the level which I've recommended. So 830, 840 would be my level to watch out for as we move on towards the expiry.
All right, and Brijesh, what about you?
I will go long on DCB Bank, keeping a stop loss of 226 and look for 248, 250 on the upside.
Okay, gentlemen, all of you, thank you so much for taking the time out and being with us today. Avinash, Brijesh, as well as Amit, really appreciate your time this morning. Important day of trade as well, and about 29 seconds left for the markets to kickstart trade. Do watch out for a lot of these result reactions predominantly today. The markets will start off flattish, so we won't have too much on the Nifty, but a lot of results to be monitored, and that is the key thing in the session today. So Page is one on the downside, NCC, Narayan Rudalaya and a couple of others on the upside. So lots of individual names that we'll try and monitor, and we'll try and talk about all of them in just moments from now. But here's how the markets are starting off this Monday morning, a week after the election result is out, or the week after the election results are out. A flat start, completely flat, no movement whatsoever on the benchmark indices. Doubt that the mid caps and the small caps will be doing something dramatically different. But let's move on, because the indices are not doing anything per se. About 0.25% for the mid cap space, so hardly any moves out here as well. So it's a flat start for the benchmark indices. Let's get the heat map up and see what's moving and what's not. So it's even Stevens. You can see equal number of green and red on the screen. Let's talk about the green first. NTPC doesn't quite react negatively to its numbers. Well, it's not a bad start, you have to say that way. Britannia about 0.5% higher, but aside of that, it's flattish. What about the losers? JSW Steel marginally off 3%, BPCL about 1.5% lower, Tata Motors about 1% lower, Z out of the numbers about 1% lower, but few and far in between. So nothing too dramatic when it comes to movers on the index per se. So the action is probably at the broader end of the spectrum. Let's quickly try and tell you about some of those stocks without wasting time. So firstly, 1% beverages clearly remains the stock in focus, though you could argue that Page Industries is also that. Maybe they will mark that, but 1% beverages, officials arrested, 20% lower. No surprise. I doubt that this will change too much in the next few days as well. What about companies that have come out with results? I want to mark a set of companies that came out with good set of numbers. Balrampur Chini, Narayan Rudalaya and Nagarjuna Construction Company, all three start off well. NCC 2.5, Balrampur Chini 5.5, 6% now. Big moves there. And Narayan Rudalaya 9% higher in trade. So quite a strong set of numbers that we've seen in the session today and the reactions thereof. Devina, what are you spotting?
We'll take a look at India Cements as well. That one also reported a strong set of numbers over the weekend. However, the stock's not reacting a whole lot of much. But do remember, the stock was up 12% in Friday's session. So you probably see some amount of profit taking once the numbers have been announced. RCF is the other one that's looking strong, 6.5% higher on the stock. You've got a GVK Power and Infra, which is up 5%. Ashoka Buildcon moves up 4%. You've got Future Retail on numbers as well, which is up about 4% in trade. Fortis Healthcare, IGL, Indraprastha Gas also reported numbers. Stocks up about 3%. National Fertilizers, Everready Industries, DB Realty are some of the bigger gainers in the session. You've got the likes of KC International as well, which is up about 2%. But Narayana Rudalaya is up about 10% right now. That's the top gainer on the Nifty 500. The top loser is 1%. We spoke about that one. DV's Lab also on the back of its numbers is down about 5% in the session. Lupin follows suit. That's down about 5% too. Ashok Leyland disappointed. The stock's down about 3.5%. And then you've got the likes of a Jet Airways down 2.5%. And even a Welspun India at 56 is down about 3%. But it's still a bull's market in terms of the advanced decline ratio. You've got a lot many more stocks advancing. 780 stocks are advancing versus 389 stocks which are trading in the red.
Okay, let's get in a very special guest on a day like this, which is also very, very important. Bharat, Iyer, Head of India Research and India Equity Strategist at JPMorgan, joins us right now on the show. Bharat, so good having you. Thanks much for joining in. What is it that you'll be telling your clients to do now? We've had arguably one of the biggest events out of the way. Yeah. Is it back to business? And therefore, what does back to business mean?
No, I think it's definitely back to business. But Neeraj, as you're aware, we've been constructive on Indian equities since November last year. And it's played out quite well. And our call is to remain constructive. Because we think that, as you rightly mentioned, the big event is out of the way. There's no political uncertainty. And I guess, now it's going to be all about the economy, corporate earnings.
Wow. It's interesting that at the JPMorgan conference, Bharat and team were amongst the few ones who at that point of time were so bullish on India. That call has paid off beautifully thus far, Bharat. How difficult it is for the markets to continue the leg that it is continuing at?
See, I think obviously, a bit of the easy money is being made because if you go back last year, markets had derated meaningfully on the back of the NBFC issues. And so that was a very good opportunity to buy in from a valuation point of view. I don't think valuations are as attractive as they were then. We were trading at 16, 17 times forward earnings. We're now up to about 19 times. But that said, I guess what works for us is that, earnings continue to recover nicely. What we've seen is in the first 9 months of this year, earnings adjusted for exceptionals have been growing at about 15%. The fourth quarter so far seems okay. So I think we're going to have a year with 15% earnings growth. This is after 4 or 5 years where we had mid-single digit growth. And I think we could repeat the same for next year as well. So we think that earnings really drive markets from here onwards.
All right. So, in your note, you've put out a Nifty target of about 12,500 for the second half of 2019. What is that going to be led by? Is it going to be only earnings?
It's going to be largely earnings. Well, you never say never, but it's difficult to see valuations re-rating from here, particularly in the kind of global environment we are in. But as I said, if you have 15% earnings growth coming through, then I think markets can give you another 6 to 8% through to the end of the year.
What are going to be the dark horses in terms of themes that you feel will play out better, or probably up until now, which have been laggards, can start to move up?
Well, I guess, the two themes that we are particularly positive on, one is banks. We think that, there are multiple tailwinds here. Credit costs have peaked out. Loan growth is recovering very well. We are back to 15% loan growth after a long time, and policy is supportive. So I think for us, banks continue to do well. The other theme that I think will likely do well is beneficiaries of government investment in infrastructure, because that is something that we believe will take off over a period of time. And we've already seen the manifesto of the BJP. I think they're talking of investing $1.5 trillion over the next 5 years. Out here, in particular, we like a couple of segments. One is steel and one is cement. Cement, we've seen very reasonable volume growth for some time now. Costs have been coming off, and what you now also see, pricing power is coming back into the sector, so that looks good. Steel, again, if you see what's happened in Brazil, it means that iron ore is going to stay well supported for some time. And Indian companies are vertically integrated, and also they have the advantage of downside protection because of MIP.
Okay. Commodities seems to be one favor, and banks is the other one that you mentioned. Bharat, the other leg on which the market stood firmly until now was consumption.
Yeah.
Now, between the last time that we spoke, which was around your conference, and now things have dramatically changed. To your mind, what are the factors? Is it largely this liquidity squeeze which is leading to this, or something else? Because Page Industries is speaking about no demand pickup in its commentary, and that wouldn't be a factor of liquidity, I guess. And part two of my question then, in your thesis again, does this revive? When does it revive? What happens to multiples thereof?
See, I guess as far as consumption is concerned, we are taking a more selective approach. And as you'll recall, we've been neutral the staple space. We have been underweight the discretionary space. I think as far as discretionary is concerned, again, one needs to make, one needs to segregate what is happening in autos with what is happening in the rest of the basket. I think the rest of the basket is reasonably well supported. We have to remember we are in late cycle as far as consumption is concerned. So, we really can't expect demand to continue to grow at the same rates. But I think if you look at a fair number of companies, demand is holding out well. I think autos has a very specific problem of bunching up of costs. I mean, between September last year and March next year, in an 18 months time span, you're going to have an increase of almost 20% in selling prices because of increased insurance, safety norms, and down the line emission norms. Now, you'll appreciate any segment if it's mid to late cycle and you have a 20% increase in selling prices. It's going to have a problem for some period of time. We think the slowdown here will last for between 12 and 24 months.
All right, just to pull out on that point. So, this has not yet happened. The cost pressure is going to start trickling.
It has started coming in, but there's more to go from what we see.
Yeah. So already ahead of that, with this, with the volume suffering so badly, do you feel that the road ahead could be slightly more bumpy than instead of this being resolved in any meaningful way?
I think the road here remains bumpy until about March or April of next year, till all the cost pressures are digested. Of course, the risk to this is if there is regulatory intervention. If, say, GST is reduced on automobiles, or you have something like that, then we'll change our thesis. But otherwise, we think the slowdown lasts till the second quarter of next year.
Because we've been talking about how since Diwali we've been talking about how there's been pushback of purchases. The interest rates were an issue. Everyone was talking about a delayed festive season. So all that played out very badly for the entire industry.
Well, I guess, the issue, as again, at the cost of repetition, is, you have the normal cyclical dynamic playing out, but then you also have an overlay of a very serious increase in selling prices, and you have to contend with that.
But you would presume that that doesn't give you a chance to accumulate these stocks as well. I mean, I'm just presuming that if it's a long cycle play, which is having a speed bump, and if valuations then come off, that you won't utilize this period to tell your clients to accumulate these names.
I would, but it again depends on the client's time frame. If someone has 3 years, then I guess through this slowdown one should be buying. But you can't be buying today, at least in my opinion, expecting upside in 3 to 6 months.
I get your point. Okay. So don't look at the very short term.
Exactly.
Yeah, look at
you need to have patience for this sector. But don't get me wrong. I mean, the penetration levels being what it is, I think it's a great long-term story. And Indian companies, particularly in this space, are very well managed and the balance sheets are in great shape.
Okay. Speaking of balance sheets, the common theme, Bharat, or the common belief seems to be that the government will spend quite a bit on infrastructure. The manifesto suggests that as well. One macro question and then a micro question. The micro question is, does the government have the balance sheet to do that in a hurry in the first 6 months itself, looking at a lot of other priorities that it has put up on its mind as well? That is part one. And part two, therefore, do the Indian infra stocks or companies give comfort to the institutional investor to go out and buy? Because arguably, there are one or two large names which should appeal to the clients that you cater to. The rest are still much smaller in size. How do people play that?
See, I guess, as far as government spending in infrastructure is concerned, Neeraj, what we need to appreciate is, as you rightly pointed out, the fiscal space is not enough to pump prime the economy at large. So I guess, they're going to have to prioritize. If you go back to the first term that this NDA government had, I mean, clearly the areas of priority were roads and highways, renewables, power transmission, and affordable housing in rural India. My call would be that these priorities perhaps will continue into the second tenure, and we need to see if they add any priorities to this and whether they have the fiscal space for it. But I guess even if you continue with these 4 or 5 areas, it's a very good starting point. So I guess yes, I think as far as these 4 or 5 areas are concerned, they'll continue to push them, and depending on when, as and when fiscal space is available, they may want to add to this, these areas. That's one part. In terms of what benefits, I guess what you're seeing is large diversified infrastructure conglomerates are doing well because they can shift their emphasis on the areas where the government is focusing, and they have the skill sets to be able to do so. Whereas companies which are tied to only a particular sector, and if that sector is not part of the priority list, too bad, they'll have to wait for more.
Okay.
And which is the reason we think that cement is something that fits in very well.
Because it will be a natural beneficiary, whichever cycle of infrastructure were to take.
Exactly.
Okay. Just one question there, and therefore, because you'll be advising your clients to do this in a meaningful way, how do you play cement then? Do you look at these pan-India large players, or do you believe that the valuation differential allows for smaller companies to come in? There's also this whole argument about how mid-caps and small caps could now start playing catch-up to large caps because large cap valuations are really looking strange.
No, I guess for the large investor, I guess they don't have a choice. Even where liquidity is, I mean, they have to buy the large names which have a pan-India presence. But yes, if you're a smaller investor who can take smaller bets, I guess there's a lot of value in the mid caps as well.
Bharat, I'm just looking at your note, and when we're talking about, excuse me, the foreign portfolio money that's been coming in, foreign institutional investors. In 2014, there was this big surge of money that came in, which took it way above average.
Yes.
So far, for 2019, that's actually below average in terms of its deviation. So do you see that normalizing, coming back to?
I think there is a good opportunity to normalize because, as you rightly pointed out, you go back to 2014, foreign portfolio investors in emerging markets were overweight on India versus the benchmark by almost 400 or 500 basis points. And currently, if you see, they are largely running a neutral position vis-a-vis the benchmark. So I guess, they've been a little cautious, they've been a little circumspect, given that, such a big event was on the way. With this out of the way, I guess there is very good scope for them to increase ratings, and which is the reason we have an overweight stance on India in the context of emerging markets, because we think that, this is a market which is under-owned, which has a good policy environment where earnings are recovering. So we think that in relative terms, it's a good place to be in.
That's actually quite a consensus opinion as well, coming in from even big FII investors suggesting that they would prefer to go overweight on India versus even China at this point.
No, absolutely. And the good part is, they have still not gone overweight. Yeah. So I guess, that's what, could lead to potential upside.
Okay. So what can throw a spanner in the works? I mean, while we're talking about all of these things picking up and starting to look good from an investment environment point of view, what could go wrong?
See, I guess, given that this big event is out of the way, I guess, the local risks to our markets have receded meaningfully. You still have some risks out there. It's not that there's absolutely nothing. I mean, if the monsoon fails us, then we're going to have a bit of another speed breaker hitting the markets and so on. But I don't see anything structurally wrong at this point in time in terms of risk factors as far as the local scenario is concerned. But what we need to keep in mind is the global environment. I think as all of us know, India has two key vulnerabilities: the dependence on external oil, the dependence on external capital. And if either one of them becomes very expensive, then that will put a big constraint on our ability to grow. Oil, I mean, obviously you will have an impact on current account, on fiscal account, on inflation. That leads to issues. I would also worry about, the environment for the cost of capital and availability of capital, because, we are at that stage where it looks like, give it 2 to 3 quarters and the investment cycle could really take off. But I don't think we have all the money to fund it. We'd welcome a lot of money coming in to fund it. And if globally markets are not in a mood to give us that money, then I guess again it will slow down the cycle.
Now I was going to ask Bharat this, the conversations that we've had on Thursday and Friday with a lot of eminent experts seem to suggest that capital might not be a problem because there are enough and more funds willing to give in money at a decent cost of capital to India. Prem Vatsa is on record saying that India could be a #1 place for FDI. You would have a good pulse, right?
Yeah.
Of what your foreign clients are talking about when it comes to not just portfolio flows, but other kind of flows as well. Are they sanguine or are they circumspect?
No, I think, the enthusiasm has always been there given the structural positives that you have, be it demographics, be it urbanization, be it the need for infrastructure and the ability to absorb capital. What you need is a very clement policy environment to ensure that this structural potential gets translated into, cyclical potential. And I guess with this event out of the way, I think investors are looking at India more positively. But as I said earlier, if there's a big global dislocation of markets, then obviously everyone's going to put their plans on hold. And that's something you don't want at this stage.
How busy were you, Bharat, on Thursday? I mean, would people have been calling in left, right, center, talking about the verdict and what your view is on that?
No, I guess, we've been talking, this has been, the key talking point as far as Indian equities are concerned for nearly a month. And obviously, it went through phases and, so we've been keeping track of it and we've been advising our clients accordingly. So yes, it's been an exciting part.
The consensus conversation is this big bang move in mid-caps that could come about and the broader market space that could come about, which has been lagging up until now, right from the start of 2018, a reversal of what happened in 2017, suddenly lost flavor and has not managed to pick up yet. But is it the issue of a few bad apples within the basket that's probably caused this entire big blowout reaction for everything in the mid-cap space? Do you see that changing?
See, I guess, it's very difficult to comment on mid-caps as a space, because, it's a very heterogeneous space.
Yeah.
And it's a very large and wide space.
There's no one theme that flows through
exactly.
it.
So, each one of us can like our 5 to 10 mid-caps. Yeah. And, we typically focus on that and, we just don't care about the rest. But, you have a universe of 500 stocks out there which you could classify as mid-caps. I think the regulator classifies almost 250, 300 stocks as mid-caps. Very difficult to, have a view on all 300 of them. But yes, selectively, I guess, given the kind of sell-off we've seen in the last 18 months, value is beginning to emerge in some areas. Like, for example, Neeraj mentioned the cement names. We definitely see value in mid-cap cement.
But just the fact that, okay, so obviously while there are a lot of the stocks that there are of different sectors within the mid-cap space, but for the mid-cap index itself, if we were to take, how it's moved vis-a-vis the Nifty 50 and the mid-cap 100 stocks, valuations at a deep discount to the Nifty 50 stocks. Even if that reverts to mean, you could see a meaningful uptick.
Look, I wouldn't disagree with that. I think there's a case to be made for mid-cap performance to accelerate a tad and some kind of catch up there. But as I said, I don't.
No meaningful outperformance.
On a 1 year basis, on a 2 year basis, I still think I would be circumspect. I'd wait for the building blocks of growth to be put in place, and only when we know that there's going to be 2-3 year run of very good growth, say in excess of 7.5%, that's when you want to go and really tank up on mid caps.
Well, you maybe gave us one headline for the day today, Bharat Iyer. Take a moment to thank you for joining in today and giving us your
Thank
thoughts.
You so
really
much.
appreciate your time.
Thank you.
That's a really important market voice. Bharat Iyer of JPMorgan telling us about his thesis of what the markets could do in the near to the medium term. Take us slip into a quick break on the note that the markets are trading flattish with the Nifty Bank being 0.5% higher. We talk about we have another market conversation. Samir Arora of Helios Capital joins us on the other side. And then a slew of result conversations post that. Stay tuned to Bloomberg Quint Live.